Welcome to Capital Link's company presentation series.
Good day to everybody. I am Nikolas of Capital Link, and I would like to welcome you to Capital Link's corporate presentation series. We have with us today the senior management of Tsakos Energy Navigation of TEN, listed on the New York Stock Exchange and major global energy transporter. The energy sector is one of the critical themes in terms of the global economy and investor interest, and we are very happy to have the Tsakos management team with us. In terms of disclaimer, very quickly to mention, this is not an offer to buy or sell any securities. This is not meant as an investment advice or advice of any kind. This presentation is strictly for informational purposes. Logistically, we will start with a slide presentation to be followed by a live Q&A session. I kindly request that any questions from the audience can be submitted through the Q&A button at the bottom of your screen, and they will be replied to by management at the end of their slide presentation. And this presentation will be archived to be accessed upon demand after the live session. And with this, I will turn the floor over to Dr. Tsakos, Nikolas Tsakos, founder, president, and CEO of TEN Limited. Dr. Tsakos, please go ahead. You are muted. Dr. Tsakos, you are muted.
No, they keep me that way. Thank you, Nicholas, and Happy New Year to everybody. And let's hope that this year might finally be the first peaceful, healthy, and uneventful year of this decade. Although I'm afraid it might not be the case, but we are still hoping for a calmer year in this decade. Although talking about calm seas, we intend this year we're going to be celebrating the 30th year since our establishment. We have learned to navigate the rough seas, being navigators and seafarers, and we have been able to grow in difficult times. So far we have been, I would say, successful in that. And as the song goes, when the going gets tough, the tough get going. And very appropriately is a song by Billy Ocean, which is very nautical with his name. But I think if you look on the first slide of our presentation, you will see that I don't know if you guys have our presentation. Very good. Yeah, I think that. So you see that in the 30 years, when we started with a minute company of 4 vessels and being reminiscent, it was an aframax, a panamax, and 2 product carriers. And we are today in a fleet in excess of 72, 73 vessels with a multiple value and a multiple earning capacity. But we have navigated through everything. Started with the Far East crisis back in '96, for those of you who are old enough to remember, at least we are all here, all of us can remember that. Then the unprecedented events of 9/11 and the collapse of trade that followed. Things started to get better after 2004, but then we had the credit crisis in 2008. And then, as I said, since 2020, it's a crisis after a crisis. But we have been able to navigate the company during even these recent difficult times successfully. This year, and Paul will tell us about it, might be one of the best years in the company's history. And what we try to do is grow the company, charter our ships long during this short periods that the market is very, very strong. So we've done more than 10 long-term charters, most of them with profit share for our ships. And Mr. Saroglou will get more into the details. We took advantage of the difficult times to order our first series of green ships of dual fuel vessels. And at the same time, in these difficult times, we secured very long contracts to expand to up to 3 vessels, our shuttle tanker fleet. So, as I said, when things are difficult, we just keep on navigating through the rough weathers and producing very, very good results. And with that, I will ask Mr. Saroglou, our COO, to tell us a little bit more details about what has happened up to this year and the beginning of this year.
Thank you, Nikos. Good morning and Happy New Year to all of you. Thank you for joining our presentation today. In slide 4, you see the pro forma fleet as it stands today. We have built a modern, diversified fleet covering both crude oil and oil product transportation, shuttle tankers, and LNG. The colors in the slide indicate the employment profile of each vessel. Dark blue is for fixed time charters, light blue is for time charters with profit sharing, and red is for spot trading vessels. 40 out of 66 vessels, or 61% of the fleet in the water today, have market exposure, a combination of spot and time chartered with profit sharing. 44 out of 66 vessels, or 67% of the fleet, are in secured contracts, fixed time charters and time charters with profit sharing. This means that TEN is capturing the positive tanker market fundamentals that prevail today. The slide has also the new building deliveries, 6 firm vessels plus 1 option that we expect to take forward. We have secured long-time charters for these deliveries. 4 out of the 6 firm vessels represent the company's entrance into green shipping, being dual-fuel LNG-powered aframax tankers. Next slide, slide 5, presents the company's current and long-term clients. We have built an industrial model, and as you can see, we have a blue-chip customer base consisting of all major global energy companies, refineries, commodity traders, with Equinor currently topping the list as our largest charterer with 9 vessels and 4 new buildings, all on long-time charters. We have the left side of this slide 6 presents the all-in break-even cost for the various vessel types that we operate in the company. We maintain a low-cost base. We have a simple operating model. We try to have our time charter vessels generate revenue to cover the company's cash needs, cash expenses, paying for the vessel operating expenses, finance expenses, overheads, chartering costs, and commissions. And we let the revenue from the spot trading vessels opportunistically contribute to the profitability of the company. Despite the prevailing inflationary pressures, we want to highlight the purchasing power of our technical manager and the continuous cost control efforts by management to maintain a low OPEX average for the fleet, while keeping a high fleet utilization rate quarter after quarter, year after year. We currently have almost 94% overall utilization for the fleet. Despite also some special surveys, scheduled and surveys that we brought forward ahead of schedule in preparation of the anticipated market upturn, so therefore 94% as overall fleet utilization is a very good number. Thanks to the profit sharing element, for every $1,000 increase in the spot rates, we have a positive 29 cents impact in annual EPS based on the number of 10 vessels that we have currently exposure to spot rates. And with that, I will pass the call to Paul for some financial highlights.
Thank you, George. So just a few comments. We can't give you year-end numbers yet, but based on the positive quarterly results through the past year, it's clear that the annual numbers will be strong. In our 9-month period, excluding non-cash items, net income amounted to over $100 million, a solid performance generating a healthy EBITDA. As a result, our cash reserves are in a far better position than at the previous year end, having increased by over $200 million and still increasing. And this, in turn, will help us to continue to reduce outstanding debt at an accelerated pace. Already in the past 6 years, outstanding debt has fallen by about $500 million, including the redemption of 2 preferred issues. And it continues to shrink. In addition, apart from share distributions, this will also help us finance new vessel opportunities that may arise in the future, while disposing several of our older vessels, generating extra cash. In the meantime, we still expect our revenue to continue to grow into 2023, as George has described.
And keep on paying dividend, which is something that we look very forward in doing. Thank you, Paul. And Harry, would you like to talk a little bit about the market conditions?
Yeah, absolutely. So let me take you over a little bit of the market statistics that we're seeing. Obviously, both on the demand side and the supply side, very favorable for tanker owners. Particularly the demand, we're seeing, global oil demand have recovered from the pre-pandemic levels, and actually the opening up of the global economies, primarily Western economies, has propelled the demand at levels higher to the ones that we saw prior to the pandemic. And that's a trend that we expect that we will continue in seeing, particularly as the Chinese are opening their economies now that their zero COVID policy that kept the country kind of locked and outside, the global agenda, if you like. They are starting up and could potentially become, again, major oil importers. So very importantly, we have been experiencing this boost in demand without the Chinese into the fray. So you can imagine that now that we have China back into the markets, that things can only look more favorable to the current levels. On top of that, that was just that on its own was good enough to propel the market to the levels, or to very solid levels. But we're very fortunate due to a very unfortunate situation, and that is the invasion of the Ukraine by Russia, that this has created a new trend in oil markets, which we expect it will be a trend that it will stay for many years to come. And that is the elongation of routes, primarily because of the banning of Russian imports or oil imports into Europe. The European importers are now are taking oil from further away distances, particularly from the US, West Africa, and the Arabian Gulf. So short-term voyages from Russia has been replaced by longer haul trades. This pattern will remain, and effectively this takes additional supply out of the market. I will go into the supply into the next slide, but that's a good enough indicator of things to come over the next few years. And if that was not enough on why we're going through this very, very strong bullish market, we'll have the supply to come and support it. Today, we are looking at one of the lowest order books in recent memory, probably one of the lowest order books in like 25, 30 years. Just to give you an idea, back in 2018, 2010, when the market got destabilized, we were looking at the order book at levels of 10%, 20%, and anything in between. Today, the order book is at just under 4%. So you can just imagine how the supply situation will look when a number of vessels currently in international trading will depart what we call the competitive fleet, the fleet that competes with us, and go into the other side of the fence, if you like, and do the non-Western trades and do the Russian trades. So effectively, we're going to have a bifurcated market, one that deals with longer term trades, as I mentioned, from the US into Europe and other longer faraway places. And the other, all those vessels, especially the older vessels that will depart the competitive arena that we operate in, will flip into the other side and do again longer term contracts from Russia into primarily into India and China. The order book, it's minute compared to the fleet that is above 15 years age. You can see that in that yellow box on the right, on the left. Effectively, what this box tells you, and this is, I think, the gist of what the situation currently, the situation that we're having, is that those vessels today, over 15 years of age, over the next 2 and 3 years, will need to depart the fleet, either, whichever, the competitive fleet that we operate, or, those ones doing the Russian trades. And the fleet that will come to replace those departing vessels is the current order book. So you can see that it's very easy to imagine that over the next, potentially from few quarters to a year or two, we could be faced with a situation where some sectors in the tanker market could experience a negative growth. Against an increase in oil demand, a global oil demand, and negative growth against China coming back into the fray, and negative growth against a prolonged war in the Ukraine translates to a sustainable, strong market environment. So this is where we are at the moment. So we're very optimistic on how things look. This is
that Harris is an investment banker. He can sell you anything. He's, I think, we share, Harris, your optimism, and thank you very much. But we always prepare for difficult times too, and that's why, and I take the cue from you, is that we are taking advantage of the highest second-hand prices that we've seen for vessels in excess of 15 years, ships that usually would be reaching the end of their life, although most of the fleet that our CEO presented to you is self-built fleet. We're very proud of our fleet. Perhaps, George, you would like to just go back, because without our fleet, we wouldn't be a shipping company. So, and as you see, every single vessel in this fleet, or 90%, has been built for us, for our clients, and that's why it can trade in very difficult times quite substantially. We are actually looking to sell up to 7 or 8 of our vessels, the older generation ships. That would give us a very big capital gain and boost for the year 2023. Of course, these are deals that they are progressing. Things might happen and they might not go through, but our aim is to modernize the fleet by taking advantage of situations where even ships that are exactly 20 years today are being built for years, are being chartered for years to major oil companies at very, very accretive rates. And that's the time when other people are there going to be making money, is to actually, as Paul said, say goodbye to some of our older vessels. And with that, we would like perhaps to open the floor if there are any questions. Thank you.
Actually, let's see. We see some questions that have been. Okay.
Ποιος το δείχνει αυτά? Πήγα πιο κοντά. Θα το δείξει, δεν βλέπω.
We have plenty of questions in the queue, and
Yes.
we can stop sharing the screen now.
Δεν ξέρω τι βλέπω σε ερωτήσεις.
So go ahead. You have so many questions in the.
Okay, let's. I think we need to click on the Q&A button to see the questions. Okay.
Σίξτο. Όχι αυτή. Κάτω στο Q&A.
Okay, let me.
Well, να βλέπουμε όλες τις ερωτήσεις.
I think we need to.
Sorry, 1 second, please, because there.
It's like a night test here, so we need to see the.
Δεν το βλέπουν όλοι, μόνο εμείς.
Δεν το βλέπουμε.
Μεγάλο shuttle. Okay, very good. Please discuss the state of the tanker
Of the shuttle
Of the
tank.
shuttle.
of the shuttle tanker market. Asset values seem to have dropped. Are asset values attracting enough to make acquisitions attractive? Okay, that's one question. When asset values drop, we consider this a good time to invest. We currently operate the 4 shuttle tankers with very long contracts. And the lower the asset values, the better the returns, because we do not buy those vessels on speculation. We buy and tie them on long, up to 15-year contracts to major oil companies. So I would say the asset value, if the asset values drop, it makes the investment more attractive.
Okay.
Will you now start returning capital to stockholders, dividend, and stock repurchase? Well, as you know, we are very much into dividend. We do not support the buying back stock, but we want to promote increasing dividends. So this is, I think, something we will propose to our board. And of course, there has been a dilution of shares when things were very difficult and the company needed to have enough resources to invest in difficult times. I think right now the company is making about $500,000 a day of positive cash flow as we speak. So of course it's time to dividend out in good time. Sorry, I'm taking some time because we're reading.
Okay.
Άστε τα κοιτάω εγώ και σου πω. We have a question on the prefs. The question is, why did we issue prefs? Again, I think you have to look back and I mean, we are a long-term player in the market. We buy, sell, and build ships against contracts at any time. And the best time to buy a vessel is when nobody would lend you money or nobody is there to compete with you. So the time when we did the prefs was, it have been very, very useful for increasing our companies against long contracts. Because this was the time in 2012 and 13 when the market was, the equity market was non-existent. I think shares were trading at $3 or $4. And that was a way to be able to go buy cheap ships against long-term contracts. And that has been a part of the backbone of the company, financing the Equinor deal, which keeps on right now expanding and extending, and it has been very, very accretive. We bought 2 of our preferreds. We might be in the process by sales of ships to decrease our preferreds even further. I think we have the right to do it as of the January this year.
Tsakos and Navy.
Okay. In 2023, you must have made new agreements for 20 ships.
Charters, I think.
Of your data, of your, what are your expectations for this?
The chartering expectations.
Yes, I think 2023, we are seeing the market very, very positive. And we always take the view that this is a good time to cover long-term our fleet for long term. For an example, let's say if we had an offer to charter one of our vessels, a VLCC, for 6 months at $80,000, I would rather do a 3-year deal at $60,000 or $65,000 or a profit-sharing arrangement at these levels, because I believe this is much better value, and it will carry us in case the market turns around.
Okay, dual fuel opportunities.
Have you seen appetite for clients on dual fuel opportunities? Yes. I have to say, and I think those opportunities have become a bit dampened by the huge price of gas because of the war. But the major oil companies are still looking at transactions like this. As I said, we've done Equinor. We're in discussion with other major companies for very similar transactions that will give us a mid-teen return, but also help us build new quality ships.
Okay. What is the dividend policy and circumstances that could lead to a larger payout?
But our dividend policy, we have never stopped our dividend, even in very, very difficult times. And of course, when things are good, our policy has always been between 25 and 50% of our net income. And I think we will not change this, which means that we will have a significant, hopefully, increase of our dividend for 2023.
Debt repayment policy and progress.
If you go to the page where we have our financials over the years, we have always tried to be conservative, always keeping the debt under 50%, and we have been able to pay dividends in difficult markets, fall by 420 million our debt, buy 2 prefs for 100 million, and still grow the company. So it has been, trying to operate what we say a tight ship.
LNG strategy and policy. Increase, decrease exposure in LNG. Can you be competitive with a small footprint?
Well, LNG has always been, we started with LNG quite early, back in 2007. However, with technology, we have never trusted, perhaps not the right word, the changes of technology, because the asset value depreciation with every change of technology is very large. I believe that we have reached, or we are reaching, a plateau of changing technology, and we are looking more and more in this segment. I mean, we have right now ships of every technology, from the very, very modern to very good steam turbine vessels. But we're looking to increase in this. What vessel class are you more bullish about over the next 3 years? And that will be our last, according to Mr. Bornozis' question. I would say that we are always looking at vessels. Aframaxes have been for us a very good size of vessels. Suezmaxes have always played a big role. So we will be looking at those vessels. However, we will prefer those vessels to be built with some sort of dual fuel arrangement. I don't think, it's not that I don't think, I'm sure we will not ordering those ships on speculations with the existing technology. And with that, we would like to welcome you to our premises, to wish you again a happy new year, and hopefully we will see everybody in New York. I think it will be about the end of March. And by then we will have even better news. Mr. Paul is sharpening his pen, and we will be providing also, I would say, some news as far as sales of vessels that will release significant amounts of cash to enhance our dividend and our buying up situation. However, the company is always very solid, with a very strong cash position to be able to take advantage of any opportunities that might arise.
And I think, Nikos, on this, there is an interesting question about vessel classes that we feel bullish about for the next 3 years.
I think, as I said, Aframaxes, VLCCs, and Suezmax but again, with some sort of dual fuel feature. Thank you very much for all, and thank you, Nick, for sorry for my throat, but thank you very much for organizing this and giving us the opportunity to catch up with our team. But and feel free to continue any more questions that we can answer even after the call. Thank you.
Thank you to the whole team. It was a very interesting discussion. You had an avalanche of questions as expected, and thank you to the participants and to the management team and Nikos for joining. As a reminder, this presentation will be archived and available to be accessed upon demand by anyone after the live session. Thank you very much, and we can all disconnect. Thank you.
Thank you.
Thank you.
Thank you.